Hello and welcome to the Business Standard Morning Show. My name is Ishan Gera and here are the stories for the day. The prolonged conflict in Ukraine, the rising global inflation, and the pursuit of central banks to keep it under control by sucking liquidity were the hallmarks of Vikram Samvat 2078. It was the worst year for financial markets in 7 years. And as we enter into Vikram Samvat 2079 today, the threat of recession in Western countries is even more prominent. Analysts believe that financial markets may see more volatility in the days to come. Here's a look at the key factors that may shape the markets this Samvat.
Samvat 2078 was a rough ride for Indian and global stock markets. While the first half was mired in FII outflows, weaker currency and supply chain disruptions, the second half witnessed a steep recovery on the back of falling commodity prices, especially crude oil. Amid all this, Indian equities proved to be resilient, bolstered by healthy retail and HNI participation, which helped offset the large outflows from foreign portfolio investors. Overall, the S&P BSE Sensex and the Nifty 50 dipped a meager 1%, while the BSE Mid-Cap Index fell about 4%. The BSE Small Cap was the only outlier with 0.1% gain. Going ahead, analysts expect Samvat 2079 to bring in greater volatility, at least in the near future, on account of deterioration in global macros and uncertainties prevailing in Western economies.
Few crucial factors which Samvat 2079 will inherit from Samvat 2078 are moving parts like inflation and interest rates in US. Whether it leads to a shallow recession or a slowdown, that's a monitorable which everyone in the market is monitoring. How the European nations' economies progress, that's also one of the monitorable. The Russia-Ukraine war, how it progresses or whether there is a resolution to it is important to also dictate the trend of commodity as well as the crude prices.
Among domestic triggers, India's response to volatility in crude oil prices will be strongly eyed by market participants.
The crude oil prices, because starting November onwards, you are going to see a cut of 20 lakh barrels per day from OPEC plus. And if there is going to be economic recovery, then demand for crude is going to go up. Added with that, you will have the winter demand, because if winter is going to be severe, I think Western countries are going to be having a lot of demand for natural gas as well as crude oil. So crude oil prices, uncertainty as far as the geopolitical situation is concerned are the two overhangs.
That said, India's outperformance over global peers, as seen in the outgoing Samvat, will likely continue this Samvat as well if the economy maintains 3 Cs.
Most likely, as we enter 2079, our market's outperformance against its global peers, which was a remarkable factor in the past few months, it is likely to sustain as fundamentals improve and profitability of the corporate sector also improve. My sense is that the 3 Cs will come to the picture. Very importantly, consumption, which is very strong right now. At least the discretionary luxury and consumption is extremely good. Second, we are seeing capex, brownfield and greenfield done by a lot of corporates which are operating at almost 100% capacity utilizations. Also, most importantly, credit growth, which was extremely strong during the 2004 to 8 period. Around 16.5% is the credit growth. So one sense one gets it that all these factors will lead to a strong rally on India once the dust settles. So once we find a little bit of semblance of stability in the global arena, India will continue to do well.
Besides, the market's reaction to foreign portfolio capital flows as against retail investors, HNI and family offices trading activity will also sway the indices this year. Today, the Indian bourses will conduct the special 1-hour Muhurat trading on the occasion of Diwali. Normal trading will be conducted between 6:15 p.m. and 7:15 p.m. Trade modification post-close will be allowed till 7:25 p.m.
Not just the financial markets, global slowdown is also putting multinational companies and their bosses in a tight spot. Google CEO Sundar Pichai lost a fifth of his wealth last year. The company too reported weaker than expected earnings recently. But the tech giant is more worried about something else: the increasing face off with antitrust watchdogs across the globe. After Europe, the Indian antitrust regulator has slapped a penalty of 1,338 crore rupees on Google for leveraging its dominant position and breaking competition rules. But does the Competition Commission of India have enough teeth to make Google pay the fine and mend its ways? Watch this report.
They are mighty and they dominate markets across continents. They are also accused of stifling competition and not allowing smaller firms to flourish. Even the United States, which is home to big tech giants like Apple, Amazon, and Google, had to come out with an antitrust bill to introduce a level playing field. But according to some reports, the bill is at risk of failing as a number of big companies are hell-bent against it and have spent millions of dollars in lobbying. Domination by a few big companies means higher prices and a lack of options for consumers like us. So we look towards the antitrust authorities to set things right. The Competition Commission of India, or CCI, has imposed a penalty of 1,337.76 crore rupees on Google. The action has been taken against the tech giant for allegedly abusing its dominant position in multiple markets in the Android mobile device ecosystem. The CCI has also issued a cease and desist order against Google and directed the company to modify its conduct within a defined timeline. Google has 30 days to provide the required financial details and supporting documents. In its response, Google said the CCI's move is a major setback for Indian consumers and businesses, and it is reviewing the order to evaluate its next steps. It added the decision opens serious security risks for Indians who trust Android's security features and raises the cost of mobile devices for Indians. This latest setback for Google comes just a month after the European Court of Justice's General Court upheld the EU Executive Commission's 2018 decision to impose a penalty on the tech giant, only reducing the fine amount from 4.34 billion euros to 4.125 billion euros. The latest EU fine is only one among a larger number of antitrust penalties, which add up to over 8 billion euros that Google could face in Europe. As on September 14, Google still had the option to move the appeal in the latest case to the EU's Court of Justice, the bloc's top court. Coming back to India, the CCI can take action against two activities: abuse of dominant position and anti-competitive conduct. It can receive a complaint from a central or state government authority or an informant. It can even look into issues on its own. If prima facie there is a case, then the Director General Office is asked to submit a report. If there is no contravention, then CCI can ask the parties concerned to share their objections, or it can decide to close the matter. However, if a case is made out, then the CCI can give directions for further inquiry or take action. What action can it take? The antitrust watchdog can issue directions to the parties concerned to discontinue such practices, re-enter negotiations, or impose a penalty. The maximum penalty can be 10% of the average turnover of the last 3 years. But if it is a cartel, then an even higher fine can be imposed. So, how likely is it that the CCI will succeed in making Google pay the India penalty? An analysis of its past record might provide an indication. The Competition Commission of India's annual report for 2018-19, which is the latest one available, reveals that most of the Commission's orders till the 31st of March 2019 were under appeal before the National Company Law Appellate Tribunal or under challenge before various high courts and the Supreme Court. A reply in Rajya Sabha in July revealed that between April 2017 and June 2022, the CCI imposed penalties amounting to 4,369.39 crore rupees in 241 cases for violations of various provisions of the Competition Act 2002. But only an amount of 197.88 crore rupees, or about 4.5% of the total, had been paid by the companies involved. The rest had been stayed or set aside by tribunals and courts. In some cases, the statutory time granted for the deposit of the penalty by the parties had not expired. A parliamentary standing committee report also revealed a decline in the budgetary allocations for the CCI in the last 4 years. The CCI was allocated 46 crore rupees in FY23 according to the budget estimates, showing no increase over the FY22 revised estimates. The funds allocated to the commission would have an impact on the resources at its disposal to pursue cases. As of March 2022, out of the sanctioned strength of 195 staff, 69 positions were vacant. Inadequate staffing is also likely to negatively impact the CCI's effectiveness. Compare this to the EU Commission staff of 800, most of which can be roped in for research. According to a 2018 news report, the CCI's research team had only 41 posts at that time. But apart from the data, what do experts have to say about where the CCI stands at present?
Stays in most of the cases is one of the major hurdles. We do not have in the CCI adequate number of people for not only research but the follow-up and so on. Quite a substantial amount of their time and energy is spent in defending their orders. So if they were having greater capacity, of course it would have helped them in following it up more assiduously. There is a competition law amendment bill pending before the parliament, and one of the amendments suggested therein is introduction of settlement and commitment provision for this in the competition law, wherein the delinquent parties so they could enter into an agreement with the CCI for settlement, or they can give an advance commitment, and penalty would also be imposed, they could be lower. So the frequency of the appeals would go down.
The action against Google follows close on the heels of the Competition Commission slapping penalties on online travel firms MakeMyTrip and GoIbibo and hospitality services provider Oyo for unfair business practices. In fact, recent times have seen many cases related to digital markets and new age companies coming up before the CCI, involving online marketplace platforms, app stores, and payment gateways, to name a few. Against this backdrop, CCI chairperson Ashok Kumar Gupta recently said that the regulator was constantly honing its toolkit to meet the challenges arising from digital markets. Gupta added that the CCI planned to hire data scientists and algorithm experts for its upcoming digital markets and data unit. While the regulator tries to become future ready, how does it compare to its foreign counterparts? And are there any solutions to the challenges it faces?
What was tabled earlier in this monsoon session, the competition amendment bill, that sort of empowering the CCI to issue specific guidelines, indicate what are the aggravating and attenuating factors for determining penalty. And once the sentencing or the penalty stage of the proceeding itself goes through that sort of rigor and gives parties that sort of certainty, then the chances of that quantum itself being revised upward or downward, irrespective of the actual merits of the case, that the scope for that sort of reduces. It has, most importantly, the power to modify contracts, and I think that's a real truth, is less in the penalties but more in the sort of remedies that it can actually grant, and those are completely at par with its peers.
Keeping aside the merits of the present case, at least the data on the actual amount of CCI penalties paid shows that the regulator could have a difficult road ahead as far as getting Google to pay up is concerned.
An early pioneer in search engines, Google continues to enjoy an edge over rivals. Indian Railways recently turned to Google Maps to ensure candidates appearing for its exam were allotted centers close to their homes. Railways, it seems, is going through an overhaul of sorts. It has hit the accelerator pedal too in its bid to give world-class service. As the bullet train project hangs fire, it recently launched a set of upgraded versions of Vande Bharat trains. So here's the question we are looking to answer. Will these 4 semi-high-speed trains make the bullet train less aspirational?
Prime Minister Narendra Modi flagged off the second Vande Bharat 2.0 train between Himachal Pradesh's Una and New Delhi on October 13th. The train will take about 5 hours and 20 minutes to cover this stretch, about 2 hours faster than the other trains. It will take 3 hours to cover the distance between Delhi and Chandigarh, which falls on the 350-kilometer route. On September 30th, PM Modi had given green signal to a Vande Bharat 2.0 train between Gandhinagar and Mumbai. The train covers the distance of 492 kilometers in 5 hours and 45 minutes, compared to 7 to 8 hours by ordinary express trains and 6 to 7 hours by the Shatabdi Express. Train 18 or Vande Bharat is the country's first engineless train. Unlike other trains, it will not have a separate engine coach. It has an integrated engine like a bullet or a metro train. Equipped with advanced state-of-the-art safety features, including an indigenously developed train collision avoidance system or Kavach, it reaches the speed of 0 to 100 km per hour in just 52 seconds. The Vande Bharat 2.0 weighs 392 tons, which is 38 tons lighter than the first two train sets that have been running on the New Delhi to Varanasi and New Delhi to Katra routes. The train's total seating capacity of 1,128 passengers is spread over 16 air-conditioned coaches, including 2 executive class coaches. This version is equipped with 32-inch screens, providing passenger information and infotainment on every coach in place of the earlier 24-inch TVs. Side recliner seat facility, which was provided only to executive class passengers earlier, will now be made available for all classes, while executive coaches will have the added feature of 180-degree rotating seats. Designed in India with 80% local materials, it costs about 110 crore rupees to make Vande Bharat rake. These trains have a top speed of 160 km per hour and reduce journey time by 25 to 45%. The average speed of mail and express trains in India has remained around 50 km per hour, while freight trains run at an average speed of just 23 km per hour. In 2019, only 62 of the 2,951 express trains in India had average speed of more than 75 km per hour. The Integral Coach Factory in Chennai will build 75 Vande Bharat trains by August 2023 and 475 by 2026. For this, existing tracks need to be uplifted. Even as the production of Vande Bharat trains ramps up, the country's first high-speed rail or bullet train project has been plagued by delays. The Mumbai-Ahmedabad high-speed rail project, the foundation stone for which was laid in 2017, will cover a stretch of 508 kilometers and is estimated to cost 1.08 trillion rupees. The bullet train would run at a speed of 320 km per hour, halving the estimated travel time between the two cities to 3 hours compared to Vande Bharat's near 6 hours. But the delay in execution is expected to increase the planned project cost. Earlier, the project was to be commissioned by December 2023. The deadline has now been extended, with the first phase to be completed by 2026 and full completion expected in 2028. So far, 90 to 95% of the 1,396 hectare needed for the project has been acquired. Besides the Mumbai-Ahmedabad high-speed rail project, 7 new bullet train projects worth around 10 trillion rupees are in various stages of planning. The newly planned routes include Delhi-Ahmedabad, Chennai-Bengaluru, Delhi-Chandigarh, and Mumbai-Hyderabad. The final sanction for these new projects will depend on the outcome of a detailed project report, techno-economic feasibility, availability of resources, and financing options. The one-way fare for the Mumbai-Ahmedabad bullet train is expected to be 3,000 rupees. Meanwhile, the ticket fare of the Gandhinagar-Mumbai Vande Bharat will be 1,440 rupees for chair car and 2,650 rupees for executive coach. With the advent of Vande Bharat trains, India's fastest yet, and their planned proliferation, will Indians still aspire for bullet trains? To get answers, we spoke to Sudhanshu Mani, the former general manager of Chennai's Integral Coach Factory, on the mastermind behind Train 18 or the Vande Bharat train set.
Bullet trains and Vande Bharat trains are two different ballgames. Now, bullet trains not only compete with air traffic, but bullet trains, say a distance between Mumbai and Ahmedabad, would render these flights totally unnecessary. Vande Bharat, it can at best try to compete with air traffic because there is, in cities like Mumbai and Ahmedabad, there is a very long commute time to and fro from the airport and so on. Both projects have to be pursued. In the entire world, except USA and Australia, among the developed countries or countries with a developed railway system, there is no country which has not gone for high-speed trains or is going for high-speed trains. India cannot be an exception. So I'm not saying that bullet trains or high-speed trains are going to be cost-effective or not, and so on. What I'm saying is, for a large country like India, instead of debating till kingdom come, you should build at least 2 lines. Based on the experience, then you decide whether you want to go for a larger network of bullet trains. Bullet trains means you start from 250 kilometers per hour to 360, 380 kilometers per hour. Whereas Vande Bharat is limited to 160. 5 years from now, we can even aspire to upgrade the track to a level of 180, 200 kilometers per hour operation. Not more than that, because that it would be better to invest in a new line.
While Vande Bharat is significantly faster than most of the current trains plying India's vast railway network, it is no match to the bullet train, whose speeds are up to twice as fast. Given its aspirations, India cannot be an outlier when most of the world's developed countries are investing in high-speed trains.
For long, railways has been absorbing all the shocks of inflation without passing them on to the passengers, making train tickets affordable for all the sections. But affordable homes are still out of reach for many. Property prices across metros and tier 2 cities are northbound again. But under construction properties are often a better option when compared to ready to move homes which are costlier. Keep watching for your checklist for buying under construction properties.
Buying a property is no easy task, and in India, buying an under construction property is fraught with risk like no other. Delayed possession, compromise with quality, and increase of property price are some of the common risks buyers are faced with. After numerous cases of defaults and delays by developers across the country, market preference has shifted decisively in favor of ready-to-move-in properties. Here, the buyer gets what he sees. However, such properties are costlier than under construction properties. But buyers with lower budget are prepared to take higher risk in anticipation of higher reward, go for under construction property. But what steps can such buyers take to reduce risk? As with all real estate, the first factor is to look at is the location. The project should be located close to or within easy traveling distance from an economic hub. Such properties tend to witness higher appreciation. Tenants are also easier to find for them. If the area is being developed, you need to be careful. The basic infrastructure, physical and social, must be in place. Don't entirely trust the seller's word that these developments will come up quickly. Make inquiries about proximity to highways and metro lines. Such upcoming infrastructure tends to provide a big, one-time boost to the price of a property. Next comes the reputation of the developer. With some legwork, you can check this out easily. Visit 2 or 3 of the developer's older projects. Speak to the residents there about the builder's track record. Had he delivered the project to them on time? If he delayed possession, did he pay the penalty as promised? How about the quality of construction? Besides the quality of construction, did the developer offer all the specifications he had promised? And was the carpet area of the flats exactly as promised? A leopard never changes its spots, nor does a developer. A developer that has been fair to its customers in the past is likely to be so in the future as well. Next, check the financials of the developer. This is easier to do in the case of listed companies. Avoid a developer that is incurring losses or is weighed down by debt. In the case of unlisted companies, try to speak to brokers and vendors, which include suppliers to the developer. On the other hand, those who delay payments are likely to be in financial trouble. If the project is already underway, visit the site and make sure that construction is not at a standstill.
I will achieve, I will fly high. SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
But as the pollution rises during the winter, authorities impose a ban on construction activities too. Experts believe that a month of ban delays the project by at least 3 months. That's all for today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.